Ever wondered how businesses keep their financial records straight? How they ensure accuracy in their financial reporting? Well, it all comes down to a fundamental accounting concept known as double entry accounting. This ingenious system is built on a simple yet powerful principle. Every financial transaction impacts at least two accounts. One account gets debited, and another account gets credited by an identical amount. And just like that, the balance of the accounting equation, assets equals liabilities plus equity, is maintained. Dive deeper into this system and you'll find that each transaction comes with two entries. Yes, every single one. These are the debits and credits, the yin and yang of accounting, if you will. They must always balance. The total debits must equal the total credits. But how do debits and credits work? Well, they represent increases and decreases in different types of accounts. The rules for debiting and crediting depend on the account type and whether the transaction increases or decreases that account. In the world of assets, debits increase them and credits decrease them. Flip the coin and you have liabilities and equity. Here, credits increase them while debits decrease them. And when it comes to revenue and expenses, revenues which increase equity are credited, while expenses which decrease equity are debited. Now, the beauty of double entry accounting is that it ensures every transaction maintains the balance of our accounting equation. It's like a tightrope walker, always staying perfectly balanced. If a company buys inventory with cash, it records an increase in inventory, an asset, and a decrease in cash, another asset. As a result, both sides of the equation remain equal. When recording these transactions, each entry is paired with a description to provide context and detail about the transaction. These entries find their home in a general ledger, which is like the master record book containing all of a company's accounts. And to ensure everything is shipshape, accountants periodically prepare a trial balance. This checks that total debits equal total credits. Any discrepancy is like a flashing red light, indicating an error that needs fixing. So there you have it. Double entry accounting, a systematic and reliable method for recording financial transactions, ensuring accuracy and integrity in financial reporting. It's the unsung hero of business, enabling companies to track their financial activities effectively, make informed decisions, and meet regulatory requirements. Quite impressive, isn't it?